Welcome to Value Investing 101, a beginner's guide to building wealth. Did you know that value investing has created more millionaires than any other strategy? It's true. Warren Buffett, one of the richest men in the world, made his fortune using these methods. Here's a shocking fact. Over the last 90 years, value stocks have outperformed growth stocks by an average of 4.3% per year. Imagine the difference that could make in your investments. Value investing is about finding undervalued stocks, the hidden gems that the market has overlooked. It's like buying a dollar for 50 cents. This strategy isn't about quick wins. It's about patience and long-term gains. And it works. In this video, we will uncover the secrets of finding hidden gems and mastering the art of patience. We'll also dive into contrarian thinking and decoding financial statements. Plus, you'll learn about the magic of margin of safety and building a resilient portfolio. Get ready to change how you think about investing. This isn't just another guide. It's your ticket to smart, profitable investing. So, let's get started on your journey to building wealth through value investing. Chapter 1. The Secrets of Uncovering Hidden Gems. Welcome to the world of value investing. Finding hidden gems is like being a treasure hunter. It's about discovering undervalued companies that have immense potential. First, let's talk about the price-to-earnings (P/E) ratio. It's a great tool. When a company has a low P/E ratio compared to its industry peers, it might be undervalued. Benjamin Graham, the father of value investing, loved low P/E stocks. He once said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This means the true value of a company will show in time. Another strategy is to look at the price-to-book (P/B) ratio. This ratio compares a company's market value to its book value. A P/B ratio below 1 can signal that a stock is undervalued. Warren Buffett, a disciple of Graham, often talks about intrinsic value. He believes you should buy a stock only if it's priced significantly below its intrinsic value. This is the essence of finding a hidden gem. Check out the company's debt levels too. A company with low debt is less risky. Look at the debt-to-equity ratio. The lower, the better. Don't forget about dividends. Companies that consistently pay dividends are often financially stable. They can be hidden gems, providing steady income. Look for companies with a strong competitive advantage. This could be a unique product, technology, or brand. These companies often outperform in the long run. Research is key. Read annual reports and listen to earnings calls. Understand the company's business model. Peter Lynch, another investing legend, says, "Know what you own, and know why you own it." This means you should fully understand the companies you invest in. Also, pay attention to insider buying. When executives buy shares, it can signal confidence in the company's future. Track historical performance. Companies that have performed well over the long term can be good bets. They might continue to do well. Sometimes, stocks are undervalued due to temporary issues. Look for companies with temporary setbacks but strong fundamentals. These can be great opportunities. A unique fact. According to a study by Tweedy, Brown Company, stocks with low P/E and P/B ratios have historically outperformed the market. Chapter 2. Mastering the Art of Patience, the Long Game. Patience is a virtue, especially in value investing. The key is to think long-term. Warren Buffett once said, "The stock market is designed to transfer money from the active to the patient." This means that those who wait often reap the biggest rewards. One strategy is to ignore short-term market noise. Daily market fluctuations are normal. Don't let them scare you. Focus on the big picture. Set a long-term investment horizon, like 5 or 10 years. This helps you ride out short-term volatility. Another tip is to reinvest your dividends. Over time, this can significantly increase your returns. Compounding is powerful. Albert Einstein called it the eighth wonder of the world. It's like earning interest on your interest. Stay informed but don't overreact to news. Markets can be irrational. Stick to your investment thesis. Regularly review your portfolio but avoid making frequent changes. Trust your research and the companies you've invested in. Remember, great companies take time to grow. Amazon, for instance, took years to become profitable. Patience paid off for those who held onto their shares. According to Fidelity, investors who held onto their stocks through downturns often achieved higher returns than those who tried to time the market. Diversification helps too. It reduces risk and can increase your chances of success. Spread your investments across different sectors. Don't put all your eggs in one basket. Use dollar cost averaging. Invest a fixed amount regularly, regardless of the market conditions. This can reduce the impact of volatility. Charlie Munger, Buffett's partner, advises, "The big money is not in the buying and selling, but in the waiting." Patience can lead to significant gains. Stay calm during market downturns. Remember, downturns are often temporary. Historically, the market has always recovered. A unique fact: according to a study by J.P. Morgan, the average annual return of the S&P 500 over the past 20 years was about 7.2%. But if you missed the 10 best days, your return would drop to 3.5%. This shows the importance of staying invested. Chapter 3. The Power of Contrarian Thinking. Swim against the tide. Value investing often means going against the crowd. Contrarian thinking is about buying when others are selling and vice versa. It takes courage and conviction. Sir John Templeton, a pioneer in global investing, said, "The time of maximum pessimism is the best time to buy, and the time of maximum optimism is the best time to sell." One strategy is to look for stocks in beaten-down sectors. When a whole sector is out of favor, you might find great companies at bargain prices. For example, during the financial crisis, many solid companies were undervalued simply because they were in the wrong sector. Another tip is to follow the smart money. Look at what successful contrarian investors are buying. Sometimes, they spot opportunities before the rest of the market. Pay attention to market sentiment. High levels of fear or greed can create opportunities. When everyone is fearful, it's often a good time to buy. Warren Buffett's famous advice is, "Be fearful when others are greedy and greedy when others are fearful." Use market corrections to your advantage. These are often short-term declines in stock prices, which can be great buying opportunities. Look for quality companies with strong fundamentals that are temporarily out of favor. Benjamin Graham taught that investing is most intelligent when it is most businesslike. This means making rational decisions based on facts, not emotions. Study market cycles. Markets move in cycles, and understanding these can help you make better decisions. Buy during bear markets when prices are low and sell during bull markets when prices are high. Contrarian investing also involves looking beyond the headlines. Negative news can create buying opportunities if the long-term outlook remains positive. A unique fact: according to a study by Dalbar, individual investors often underperform the market due to poor timing decisions driven by emotions. Develop a thick skin. Contrarian investing can be lonely. You might face criticism for going against the trend. But if your research is solid, stick to your guns. Pat Dorsey, in his book, The Little Book That Still Beats the Market, says, "You can outperform the market by finding great businesses and buying them at good prices, even if everyone else thinks you're nuts." This highlights the essence of contrarian thinking. In summary, contrarian thinking is about recognizing opportunities where others see risks. It requires courage, research, and a long-term perspective. By swimming against the tide, you can uncover hidden value and achieve significant returns. Chapter 4. Decoding Financial Statements, Your Treasure Map. Understanding financial statements is crucial for value investors. These documents are like a treasure map, guiding you to hidden gems. The three main statements are the balance sheet, income statement, and cash flow statement. The balance sheet shows a company's assets, liabilities, and shareholders' equity. It gives a snapshot of the company's financial health. Look for companies with strong balance sheets, meaning more assets than liabilities. The income statement shows the company's revenues, expenses, and profits over a period. It helps you understand how the company makes money and manages costs. Focus on net income, which is the profit after all expenses. Consistent net income growth is a good sign. Also, check the operating margin. This shows how much profit a company makes from its operations. Higher margins indicate efficient management. The cash flow statement shows the inflows and outflows of cash. It's crucial because it reveals the company's liquidity. Operating cash flow is key. It shows how much cash the company generates from its core business. Look for positive cash flow from operations. This indicates the company can sustain its operations and grow. Free cash flow is also important. It's the cash left after capital expenditures. Companies with strong free cash flow can invest in growth and pay dividends. A unique fact: according to a study by Harvard Business School, companies with strong free cash flow tend to outperform the market. Use ratios to analyze financial statements. The current ratio measures liquidity. A ratio above 1 means the company can cover its short-term liabilities. The quick ratio is more stringent, excluding inventory from current assets. It's a good indicator of liquidity. Debt ratios are also important. The debt-to-equity ratio shows the balance between debt and equity. Lower ratios are generally better. Look for trends in the financial statements. Consistent improvement is a positive sign. Be aware of red flags. High levels of debt, declining revenues, or negative cash flow can be warning signs. Peter Lynch advises, go for a business that any idiot can run, because sooner or later, any idiot probably is going to be running it. This means look for companies with simple, understandable financials. Chapter 5. The magic of margin of safety, your investing shield. The margin of safety is a key principle in value investing. It's like a shield, protecting you from potential losses. Benjamin Graham introduced this concept, emphasizing its importance in making sound investments. He said, the margin of safety is always dependent on the price paid. One strategy is to buy stocks at a significant discount to their intrinsic value. This provides a cushion against errors in judgment or unexpected market downturns. Calculate the intrinsic value by looking at a company's earnings, dividends, and growth potential. Tools like discounted cash flow, DCF, analysis can help. Set a high margin of safety. Graham recommended a 50% discount to intrinsic value. This means if a stock's intrinsic value is $100, buy it for no more than $50. This approach reduces risk and increases potential returns. Look for companies with a strong track record of earnings and dividend growth. Consistent performance indicates stability and reliability. Focus on businesses with competitive advantages. These could be unique products, strong brands, or proprietary technologies. Such companies are more likely to sustain their profitability over time. Pay attention to debt levels. Companies with low debt are less risky and more likely to survive economic downturns. Another strategy is to diversify your investments. Spread your money across different sectors and industries. This reduces the impact of any single investment going wrong. Peter Lynch once said, the best stock to buy is the one you already own. This highlights the importance of knowing and trusting your investments. Use conservative estimates when calculating intrinsic value. Be realistic about growth rates and profit margins. It's better to be pleasantly surprised than disappointed. A unique fact. According to a study by MSCI, companies with high margins of safety have historically outperformed the market by an average of 2-3% annually. Regularly review and reassess your investments. Ensure they still offer a margin of safety. Sell stocks that become overvalued. Warren Buffett advises, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This means prioritize quality over cheapness. In summary, the margin of safety is your investing shield. It protects you from losses and enhances your chances of success. By buying undervalued stocks with a significant margin of safety, you can build wealth and reduce risk. Chapter 6. Building a resilient portfolio. Diversify like a pro. Diversification is crucial in value investing. It's about spreading your investments to reduce risk. A well-diversified portfolio can withstand market volatility and improve returns. One strategy is to invest across different sectors. Don't put all your money in one industry. For example, if you have tech stocks, add some healthcare or consumer goods stocks too. This balances your risk. Include a mix of small, mid, and large cap stocks. Each category has its own risk and return profile. Large cap stocks are generally more stable, while small cap stocks offer higher growth potential. Look for international opportunities. Investing in global markets can provide exposure to different economic cycles. This further reduces risk. Consider different asset classes. Besides stocks, include bonds, real estate, or commodities. Each asset class responds differently to market conditions. Rebalance your portfolio regularly. Market movements can shift your asset allocation. Rebalancing ensures you maintain your desired risk level. Warren Buffett says, diversification is protection against ignorance. It makes little sense if you know what you are doing. While this highlights the value of knowledge, diversification still provides a safety net. Focus on quality investments. Diversification doesn't mean buying anything. Look for solid companies with good fundamentals. Use index funds or ETFs for broad exposure. These funds track a market index and offer instant diversification. They are also cost-effective. A unique fact: according to Vanguard, a well-diversified portfolio can reduce risk by up to 30% compared to a concentrated one. Consider your risk tolerance. Younger investors can take more risks, while older investors should prioritize stability.